Returns on investment. Delayed rewards for costs incurred earlier are a return on investment, whether these rewards take the form of dividends paid on corporate stock or increases in incomes resulting from having gone to college or medical school. One of the largest investments in many people's lives consists of the time and energy expended over a period of years in raising their children. At one time, the return on that investment included having the children take care of the parents in old age, but today the return on this investment often consists only of the parents' satisfaction in seeing their children's well-being and progress. From the standpoint of society as a whole, each generation that makes this investment in its offspring is repaying the investment that was made by the previous generation in raising those who are parents today. Unearned income. Although making investments and receiving the delayed return on those investments takes many forms and has been going on all over the world throughout the history of the human race, misunderstandings of this process have also been long-standing and widespread. Sometimes these delayed benefits are called unearned income, simply because they do not represent rewards for contributions made during the current time period. Investments that build a factory may not be repaid until years later, after workers and managers have been hired and products manufactured and sold. During the particular year when dividends finally begin to be paid, investors may not have contributed anything. But this does not mean that the reward they receive is unearned, simply because it was not earned by an investment made during that particular year. What can be seen physically is always more vivid than what cannot be seen. Those who watch a factory in operation can see the workers creating a product before their eyes. They cannot see the investment which made that factory possible in the first place. Risks are invisible, even when they are present risks, and the past risks surrounding the initial creation of the business are readily forgotten by observers who see only a successful enterprise after the fact. Also easily overlooked are the many management decisions that had to be made in determining where to locate, what kind of equipment to acquire, and what policies to follow in dealing with suppliers, consumers, and employees, any one of which decisions could spell the difference between success and failure. And of course, what also cannot be seen are all the similar businesses that went out of business because they did not do all the things done by the surviving business we see before our eyes, or did not do them equally well. It is easy to regard the visible factors as the sole or most important factors, even when other businesses with those same visible factors went bankrupt, while an expertly managed enterprise in the same industry flourished and grew. Nor are such misunderstandings inconsequential, either economically or politically. Many laws and government economic policies have been based on these misunderstandings. Elaborate ideologies and mass movements have also been based on the notion that only the workers really create wealth, while others merely skim off profits, without having contributed anything to producing the wealth in which they unjustly share. Such misconceptions have had fateful consequences for moneylenders around the world. For many centuries, moneylenders have been widely condemned in many cultures for receiving back more money than they lent, that is, for getting an unearned income, for waiting for payment, and for taking risks. Often the social stigma attached to money lending has been so great that only minorities who lived outside the existing social system anyway have been willing to take on such stigmatized activities. Thus, for centuries, Jews predominated in such occupations in Europe, as the Chinese did in Southeast Asia, the Chettiars and the Marwaris in India, and other minority groups in other parts of the world. Misconceptions about money lending often take the form of laws attempting to help borrowers by giving them more leeway in repaying loans. But anything that makes it difficult to collect a debt when it is due makes it less likely that loans will be made in the first place, or will be made at the lower interest rates that would prevail in the absence of such debt protection policies by governments. Debtor protection policies by governments. In some societies, people are not expected to charge interest on loans to relatives or fellow members of the local community, nor to be insistent on prompt payments according to the letter of the loan agreement. These kinds of preconditions discourage loans from being made in the first place, and sometimes they discourage individuals from letting it be known that they have enough money to be able to lend. In societies where such social pressures are particularly strong, incentives for acquiring wealth are reduced. This is not only a loss to the individual, who might otherwise have made wealth by going all out. It is a loss to the whole society when people who are capable of producing things that many others are willing to pay for may not choose to go all out in doing so. Investment and allocation. Interest, as the price paid for investment funds, plays the same allocational role as other prices in bringing supply and demand into balance. When interest rates are low, it is more profitable to borrow money to invest in building houses, or modernizing a factory, or launching other economic ventures. On the other hand, low interest rates reduce the incentives to save. Higher interest rates lead more people to save more money, but lead fewer investors to borrow that money when borrowing is more expensive. As with supply and demand for products in general, imbalances between supply and demand for money lead to rises or falls in the price, in this case, the interest rate. As The Economist magazine put it, most of the time, mismatches between the desired levels of savings and investment are brought into line fairly easily through the interest rate mechanism. If people's desire to save exceeds their desire to invest, interest rates will fall, so that the incentive to save goes down and the willingness to invest goes up. In an unchanging world, these mismatches between savings and investment would end, and investors would invest the same amount that savers were saving, with the result that interest rates would be stable because they would have no reason to change. But in the real world, as it is, interest rate fluctuation, like price fluctuations in general, constantly redirect resources in different directions as technology, demand, and other factors change. Because interest rates are symptoms of an underlying reality and of the constraints inherent in that reality, laws or government policies that change interest rates have repercussions far beyond the purpose for which the interest rate is changed, with reverberations throughout the economy. For example, when the U.S. Federal Reserve System in the early 21st century lowered interest rates in order to try to sustain production and employment, in the face of signs that the growth of national output and employment might be slowing down, the repercussions included an increase in the prices of houses. Lower interest rates meant lower mortgage payments and therefore enabled more people to be able to afford to buy houses. This in turn led fewer people to rent apartments, so that apartment rents fell because of a reduced demand. Artificially low interest rates also provided fewer incentives for people to save. These were just some of the many changes that spread throughout the economy, brought about by the Federal Reserve's change in interest rates. More generally, this showed how intricately all parts of a market economy are tied together, so that changes in one part of the system are transmitted automatically to innumerable other parts of the system. Not everything that is called interest is, in fact, interest, however. When loans are made, for example, what is charged as interest includes not only the rate of return necessary to compensate for the time delay in receiving the money back, but also an additional amount to compensate for the risk that the loan will not be repaid, or repaid on time, or repaid in full. What is called interest also includes the costs of processing the loan. With small loans especially, these process costs can become a significant part of what is charged because process costs do not vary as much as the amount of the loan varies. That is, Lending $1,000 does not require 10 times as much paperwork as lending $100. In other words, process costs on small loans can be a larger share of what is loosely called interest. Many of the criticisms of small financial institutions that operate in low-income neighborhoods grow out of misconstruing various charges that are called interest but are not, in the strict sense in which economists use the term for payments received for time delay in receiving repayment, and the risk that the repayment will not be made in full or on time or perhaps at all. Short-term loans to low-income people are often called payday loans, since they are to be repaid on the borrower's next payday or when a Social Security check or welfare check arrives, which may be only a matter of weeks or even days away. Such loans, according to the Wall Street Journal, are usually between $300 and $400. Obviously, such loans are more likely to be made to people whose incomes and assets are so low that they need a modest sum of money immediately for some exigency and simply do not have it. The media and politicians make much of the fact that the annual rate of interest, as they loosely use the term interest, on these loans is astronomical. The New York Times, for example, referred to an annualized interest rate of 312% on some such loans. But payday loans are not made for a year, so the annual rate of interest is irrelevant, except for creating a sensation in the media or in politics. As one owner of a payday loan business pointed out, discussing annual interest rates on payday loans is like saying salmon costs more than $15,000 a ton, or a hotel room rents for more than $36,000 a year, since most people never buy a ton of salmon or rent a hotel room for a year. Whatever the costs of processing payday loans, those costs, as well as the cost of risk, must be recovered from the interest charged, and the shorter the period of time involved, the higher the annual interest rate must be to cover those fixed costs. For a 2-week loan, payday lenders typically charge $15 in interest for every $100 lent. When laws restrict the annual interest rate to 36%, this means that the interest charged for a 2-week loan would be less than $1.50, an amount unlikely to cover even the cost of processing the loan, much less the risk involved. When Oregon passed a law capping the annual interest rate at 36%, 3/4 of the hundreds of payday lenders in the state closed down. Similar laws in other states have also shut down many payday lenders. So-called consumer advocates may celebrate such laws, but the low-income borrower who cannot get the $100 urgently needed may have to pay more than $15 in late fees on a credit card bill or pay in other consequences, such as having a car repossessed or having the electricity cut off, that the borrower obviously considered more detrimental than paying $15, or the transaction would not have been made in the first place. The lower the interest rate ceiling, the more reliable the borrowers would have to be in order to make it pay to lend to them. At a sufficiently low interest rate ceiling, it would pay to lend only to millionaires, and at a still lower interest rate ceiling, it would pay to lend only to billionaires. Since different ethnic groups have different incomes and different average credit scores, interest rate ceilings virtually guarantee that there will be disparities in the proportions of these groups who are approved for mortgage loans, credit cards, and other forms of lending. In the United States, for example, Asian Americans have higher average credit scores than Hispanic Americans or Black Americans, or white Americans for that matter. Yet people who favor interest rate ceilings are often shocked to discover that some racial or ethnic groups are turned down for mortgage loans more often than others, and attribute this to racial discrimination by the lenders. But since most American lenders are apt to be white and they turn down whites at a much higher rate than they turn down Asian Americans, racial discrimination seems an unlikely explanation. Where there are lenders who specialize in large short-term loans to high-income people with expensive possessions to use as collateral, these collateral lenders, essentially pawn shops for the affluent or rich, charge interest rates that can exceed 200% on an annual basis. These interest rates are high for the same reasons that payday loans to low-income people are high. But because the high-income loans are secured by collateral that can be sold if the loan is not repaid, the high interest rates are not as high as with loans to low-income people without collateral. Moreover, because a collateral lender like PawnGo makes loans averaging between $10,000 to $15,000, the fixed processed costs are a much smaller percentage of the loans, and so add correspondingly less to the interest rate charged.